Hello, everyone. My name is Andrew Hinrichs, and I'm a financial advisor with Horizon Advisors, an independent wealth management firm that specializes in financial planning. What we're going to do today is get a little insight on how we work with our clients in a financial planning capacity and ultimately how we do financial planning. One of the things that has been a lot of people's minds lately due to the market volatility and this unfortunate coronavirus pandemic is their financial situation. Asking a lot of questions about whether or not they're in the right place, if their investments are set up correctly for their goals, and ultimately what the purpose is behind what they have. Financial planning is crucial, and we sit with hundreds of people each year, and they think they're doing financial planning, but when we sit down with them and go through the process, in reality, they even realize that they're not truly doing financial planning. So the goal of this webinar is to go through how we do financial planning, kind of show you a little bit on why it's so important and why it's so crucial for times like this specifically. So we're going to start out. We got John and Jane Doe here, and what we did was I went and made up a example client and an example situation to go through today. So we're going to go through that, starting with the base facts. So what we typically do in the first meeting would be to gather all the facts that we would need to build out this plan. Things like cash flow, income, assets, financial goals, estate planning, life insurance, things of all that would be gathered in a first meeting. And then we would take all that information that we get in the first meeting, and in the second meeting, we would go through what we put together from a financial planning capacity. So our process is a two-step process, and there's no charge or fee to go through that two-step process. But the reason why that first meeting is so crucial is because it's kind of like going into the doctor's office and saying, "Hey, doctor, I think I'm having a problem with my heart. What's wrong with it?" And the doctor's like, "Well, John, I hope nothing's wrong with your heart, but I can't do anything unless I run some tests. I need to know what's going on." And that's similar to people's financial situations, is coming in, and we got to make sure we have all the details to be able to do the correct analysis. So we take that information and build it out into the plan, and then we go through it all in the second meeting. So what we're going to go through today is that process of like we are sitting in a second meeting with John and Jane Doe and going through their financial plan. So I wouldn't focus too much on the numbers. If the net worth or the investments don't relate to your specific situation, just think about it conceptually and from the point of why financial planning and answering some of these questions is so important. So without further ado, let's start going into the facts. So what we first do is, we clarify with John and Jane what's going on and clarifying what's happening from a factual standpoint in the information that we gathered in that first meeting. So, John, we have your date of birth 7/7/1956. You're 63. Jane, you're born on 5/2/1956, and you are also 63. John, you're an engineer at the automotive company. Jane, you're a registered nurse at a local hospital. You both want to retire at 65. Now, that's one of the questions we gathered in our first meeting when we had a conversation. You said your goal was for both of you to retire at age 65, so that's what we have built in to the plan. One of the assumptions that we do built in as well is that you both live till age 90. We like to plan for our clients to live long lives, long and healthy lives, so that's one of the assumptions we built in, is living till age 90. John and Jane, you have two children, Kevin, who's 39, Sally, who's 37, and combined between Kevin and Sally, you have 5 grandkids, Andrew, Colin, Ryan, Sarah, and Isabella, all in their early teens. Does all this look correct, John and Jane? Awesome. Let's move on to the goals. So obviously financial planning is all about goal setting and what you want to have accomplished at the end of the day. And we start with retirement as the main goal because we obviously have to pick something that is crucial right now for your financial situation. There's no point to start with 10 goals when we need somewhere to go, to start off. So Obviously, as we're going through this process, John and Jane will build out more goals along the way. But for right now, the major concern in your situation is retiring if you can or cannot retire. So we're going to focus on that goal today. But as we continue on the process, like I said, adding goals like leaving money to heirs or maybe paying for a grandkid's education, things of that nature, all of those things can be built out as we continue on the planning process. Sound good? Great. So let's confirm a few things in the net worth here. And these are the numbers that we gathered just from our first meeting that we asked you the questions and you gave us these numbers. So just to confirm here, checking and savings, around 50,000. John and Jane, you do have your estate planning done. You have a trust account that's around $100,000. Jane, your 403B through work is around $400,000. John, your 401k through your employer is around $600,000. And we're going to skip this right now for just a second, come back to it. Your family home is valued around $400,000 with a mortgage liability left of $100,000, giving you a total net worth of around 2.25 when we add in the lump sum. Now, John, I know we mentioned one of the first reasons why you wanted to sit down and have this planning conversation was because you're coming up to maybe your 30th year here at your company, and there is an offer on the table for possibly taking the pension as a lump sum versus taking it as an income stream. So we went ahead and did that analysis for this presentation. Right now, we have that lump sum built in as an asset, and we're going to go into why we think that we should build it in that way versus as an income stream. So while we're on that topic, John, how about we go to that right now and take a look at it? So John, based on the facts that you gave us in the first meeting, we went ahead and did a little analysis on your pension options. So there are multiple different options, and we can go through all those in more depth. Today, we wanted to pick the best two options and kind of compare them side by side so you can look at it from a financial standpoint and make a proper decision. So what you'll see here is that's the income per year that you would receive from your pension option, $54,926.16. That's what the pension amount would give you each year from an annual standpoint. The pension lump sum option that you have on the table is $918,000. So basically you have the option to receive the $55,000 roughly of income from the pension each year, or you could take the $918,000, roll it into an IRA, and take everything up front. Now, there's pros and cons to each of these situations, John, but we're going to take a look and go through the two that we think make the most sense. So what we did in this spreadsheet, you can see the $55,000 roughly that's coming in each year. It's a cumulative number. So you can see that number just keeps getting added and added each year as we go on through the years. That's where these numbers are coming from. On the right-hand side, you'll see taking the lump sum and withdrawing that same amount, the $55,000, while earning a 5% rate of return on this $918,000. So let me put it a little more simply. Basically, the option you have, if you're a disciplined person, which you seem like you are, John, you could take the lump sum option, and what would it look like if you would pull the same exact amount of money that the pension was going to give you out of that lump sum bucket, while that lump sum bucket is also earning a certain percentage of rate of return because it is invested. So if you were to do that, take that $55,000, just like the pension was going to give you, out of this bucket of money, what would that look like at the end of the day? So we're assuming a 5% rate of return on this bucket of money right now. And if we scroll down, John, when you're age 90, right here, like that life expectancy that we spoke about earlier, in 2045, if you withdrew that $55,000 each year from the bucket, this is what you're left over at the end of the day versus this is what you would have received from the pension company. So as you can see, if you earned a 5% rate of return over those years and withdrew the $55,000 each year, just like you received from the pension company, your family would still have roughly $500,000 left over at the end of the day. And that's quite a substantial amount to leave on the table if you were to take the pension annual monthly income from them. So and we can play around with this number a lot. This is something you just build right in. So even if you want to look at it more conservatively, say, Andrew, you know what? I don't think 5% is realistic with how I want it invested. Let's take a look at it, what it would look like with a lower rate of return. You know, we can scroll down even at 4%, $160,000 left at age 90 with the lump sum option versus taking the pension. Could go even lower, and I think for this conversation, 3.5, even though it says 4, it's still at 3.5 up there. 3.5 is kind of the break even. So if you earned at least 3.5% on that money, that bucket of money, over that time frame, you would still be beating what you would get from the pension. And there's a lot of factors that go into this too, John. I mean, one scenario we're looking at right here is a 75% survivor option from that pension, because that is the option you want. You want to make sure that if you took this option, that your family's still going to get some of the benefit that you worked hard for. Well, we're not even factoring that into this situation. We're just saying, hey, if we're taking that $55,000, we're assuming you live till age 90, so it never goes down to that 75% yet. But God forbid something happened to you, John, here in 2029 or maybe 2035, that 75% reduction is going to happen right here, which is just ultimately going to make this bucket of money grow even farther. So we think after this analysis, especially with a 3.5% rate of return assumption, we think it's a very good opportunity to take control of your money right now versus betting on the pension company, which again, we can go into that rabbit hole. And we would like to believe that your company's been along for a long time. They're a well-known company and they're respected and the pension's healthy. But at the end of the day, John, just like this coronavirus and what we're seeing right now, you know, we don't know at the end of the day. So there's also advantage of taking the money up front and being in control. So after going through that analysis internally, we realized that we would like to present to you the option of taking that lump sum because we feel it is more of a leverage and better option for your situation. So going back to the plan now, that is why we have the lump sum option built in here as an asset. Make sense? Great. So now let's go into income. And John and Jane, at the end of the day, financial planning, retirement planning, distribution planning, it's all about cash flow. You know, what's coming in versus what's going out. So let's take a look at what's coming in right now. Jane, you have your salary through your work, around $70,000 a year. John, you have $130,000 coming in from salary from your work, totaling around $200,000 gross between the two of you each year. We have your Social Security built in here. Because of the plan, you have it start withdrawing at age 67, which is full retirement age for both of you. And the reason we use that in the base fact scenario is because even though you guys are right at the cusp of drawing Social Security right now, we do plan for you to work till 65. And we want to make sure that we're addressing Social Security the right way. So when we get a little closer, we'll take a look if it makes sense drawing it early. But as of right now, 67 seems like a good bet for your situation. So these numbers are flowing in automatically based on the formula we have built in there. Look good? Great. So that's what's coming in. Now let's look at what's going out. So in terms of expenses, so again, going back to cash flow, in that first meeting, John and Jane, we spoke about, you know, what is coming in and how it's reflecting on your bank account. So on a monthly basis, you essentially saw your bank account staying relatively neutral, maybe slightly positive on a month-to-month basis. It's growing a little bit. But you didn't know exactly how much you were spending. You just kind of assumed it was growing and that was that. So based on our conversation, we believe that you're spending probably around $85,000 a year on lifestyle. So that doesn't include the mortgage, as you can see here, and it doesn't include taxes. That's just on John and Jane, groceries, going out having fun, gas, and all the other miscellaneous items that are throughout your life. So we feel like this is a pretty close number of where you're at. And I'll sit here and I'll spend a lot of time with the client, you going over exactly where we are at here. If we're off, if we're close, if that makes sense, because we really want to tailor down the cash flow. Because ultimately, again, like I said before, financial planning and retirement planning is all about the cash flow. So we'll spend some time here with the client, seeing if this makes sense and kind of gauge that conversation going from there. But going back to John and Jane, we think this is really a close perspective of where you're at. We do have your mortgage built in here. This is a prorated amount for the rest of the year. We've already had a couple months into 2020, so that's why this seems a little low. When we go into the plan here in a second, you'll see that the full amount, annual amount, is flowing in correctly. And then, like I said, tax assumptions, we do have taxes automatically built in. So we have your the federal tax rate and then the state tax of Michigan, because we live in Michigan, automatically built in as well. Does that look all good? Awesome. So now let's go into savings and contributions. So Jane, we'll start with you. You're contributing 5% of your salary into your 401k through work. And what that's giving you is the employer is matching 3% of that into your account as well. John, through your 401k through work, you are contributing 10% of your salary into the 401k, and your employer is matching 5% of that salary. Those numbers look right? Great. And then we go from there. These last three tabs, for the sake of the second meeting, John and Jane, we would like to build these out as we go through the process. Protection is more dealing with life insurance and estate planning, and asset allocation has to do with your specific holdings and investments. Those are more for later down the road, so we're not going to focus on those too much today. And observations and next steps would be, in our first meeting, John and Jane, we had some kind of red flags or things that stuck out to us that we wanted to make sure we clarified. For the sake of this conversation, John and Jane, nothing stood out to us that we thought we would need to build in, so there are no observations and next steps from us. But if there were some, while we're going through the process, we'll build in notes, questions, things that we want to make sure we consider in that observation next steps tab. So what I would do from here, again, confirming all the facts that we gathered through the first meeting, making sure that we're on the same page. If there is something like the pension lump sum option that we went through back in the net worth section, I'll go through that with the client, going through and confirming the facts. After we go through all that, I go, John and Jane, all the facts that we clarified from the first meeting are all good to go. Now let's go into the financial plan itself. So what I said before, John and Jane, about cash flow and about retirement planning, distribution planning, it is all about cash flow. What's coming in and what's going out. And we drill that, a lot with our clients to make sure that they understand that cash flow is ultimately what is most important. Again, we sit with hundreds of people, and at the end of the day, we see that the clients really feel happy, healthy from a financial standpoint when their cash flow is happy and healthy. You can have millions of assets, but if your cash flow is not where you think it should be, or you're spending too much of your situation, you don't feel comfortable, you might not feel wealthy or rich per se at the end of the day. But if your cash flow is rich and healthy, you feel that way in a financial standpoint too. So John and Jane, that's where I really want to focus today. We have tons of reports available to us, but for today, the sake of today's conversation, we're going to take a look at the cash flow report. So John and Jane, I'm going to scroll down here and you're going to see a bunch of numbers. Before I scroll down and go through all this, there are a few assumptions that are built into this plan that I want to make sure that we're going through. The first one we already covered in the facts, which was the age expectancy, life expectancy to age 90. So we do plan for you guys to live a long life, and we hope you live a happy and healthy life throughout until 90. That's the first assumption. The second assumption is that we do account for inflation in this plan. So you'll see your income, your expenses growing a little bit each year, and we're doing that to take pace with inflation, so you're making sure that your purchasing power stays intact over those years. The third assumption is that with the money invested, similar to the pension lump sum analysis we just went through, we're assuming that the money that is invested is earning a 5% rate of return over these years. Again, long-term, especially for your situation, John and Jane, we feel that that is a conservative number long-term. We do like to plan conservatively with our financial planning and with our clients so that we make sure that we're analyzing the situation in a proper way and not getting too ahead of ourselves with unrealistic proportions and assumptions. So those three assumptions are built in. Make sense? Great. So then I scroll down here, John and Jane, and basically with all these numbers, we're going to tackle them all one by one in a second here. But going back to our conversation from the first meeting, you said you wanted to enjoy your life. You wanted to, spend some of this money that you worked so hard to save after all those years. And basically what this is showing you is a base fact scenario. If you never came and talked to us, you never came and met me, and you were just going to continue on the way that you guys were continuing on, you're going to retire at 65, spend what you're spending, do what you wanted to do, and that was that. Based on the assumptions that we just went through and that we built in, if all that stayed true, at the end of the day, you'd be leaving around $3.5 million to your beneficiaries at age 90. That doesn't include the house, any personal property, or other physical assets that you may have. So, John and Jane, before we really get into it, how does that number make you feel? Is that something you feel comfortable with leaving to beneficiaries? Did you want to maybe spend a little bit more than that? Do you think you've already given enough maybe to your beneficiaries where you think you deserve to spend more of this? And we'll spend a little time here with the clients talking about the base fact scenario of if everything stayed true and the assumptions were the assumptions and you never met us, is this situation the one that you want to have happen? And we'll talk about that for a little bit with John and Jane and figure out exactly where their head's at looking at this situation. Obviously, going off those assumptions, life, unfortunately, doesn't work out like that. There's always going to be something, a wrench that'll be thrown into this gear where this base fact scenario won't happen. But again, it's more or less of just showing the numbers to say, in reality, if everything did hold true, this is what's going to happen. So how does this all work? Again, this is all about cash flow, John and Jane. So if you look at the left-hand side here, this is your income. So what's coming in versus on the right-hand side over here, this is your expenses or what's going out. So we'll go into each line item specifically here to show exactly where these numbers are flowing from. Similarly to what we just went through in the facts a little bit ago, you can see we have Jane, we have your salary right here. John, we have your salary right here. These are prorated numbers for the rest of the year because we have seen a few months into 2020. And this blue line right here is when you retire. So you said you want to retire 65 at the end of the year 2021. So you'll have your full salaries worth of 2021. And then as you can see, your salaries drop off because you're retired and you're going into the retirement mode. At that point, the income that's coming in, because of the fact that we're taking the pension lump sum and looking at that option, the only income coming in would be Social Security. So you can see in 2022, your partial year, you got a little bit of Social Security in that year, and then 2023, Social Security fully kicks on for both of you, and that's the income that's coming in for you guys from Social Security all the way until age 90, and that's what's coming in as income. Does that make sense? Great. So we go back to the cash flow report. Stay on that left-hand side of what's coming in. One of the key items for John and Jane for your situation is these planned distributions. And so what does that mean? Well, that's your RMDs, your required minimum distributions that you're going to have to take out of your account at age 72. Now, we recently just went through a Secure Act update where they changed the RMD from 70.5 to 72. So you can see here in 2028, when you're both 72 years old, the IRS is going to require you to take a certain percentage out of those pre-tax, those qualified plans that you had, the 401k and the 403b. IRS is going to have a certain percentage. Uncle Sam wants his money, so you're going to be required to take that out whether you like it or not. So if we go down to 2028 when you're 72, you will have some more income coming in because you're going to have Social Security right here, plus the RMDs that are going to be coming out of your accounts. But for the sake of today's conversation, we'll stick to the present time and kind of look at retirement. You know, these crucial years right here, when really all what's coming in is Social Security, those are going to be important years to talk about. But that's what's coming in from an income perspective. Take a look at this right-hand side over here, and let's take a look at what's going out. So again, if you look at total expenses, and we'll go into this line by line. These are your living expenses that we went through a little bit ago in the facts. So again, this year's prorated. So let's look at 2021 as the option here. So let's look at 2021 as the option here. In 2021, you have those living expenses of $85,000 inflated a little bit for inflation, like we mentioned, so they're up to $86,000. Then you have your liability payments on the mortgage, like we spoke about, which is going to get paid off here in 2025. A little bit of payment left in 2025, plus taxes. So you have your lifestyle, plus your liability payments, plus taxes equals your total expenses. And as we're going through this financial planning process, we build in specific line items to make this really, really tailored to your situation. So, you know, maybe we build in home and auto insurance or P&I if they're separate from mortgage, things like that. If there's specific line items that we want to build in, we can build out all of those to make sure we're analyzing each specific situation. But if you add up all of these columns, that's what you get from your total expenses. And if you look at here, once you retire, and we're at age 66, 67, 68, 69, these years where Social Security is coming in, you know, you're virtually, with standard deduction and what taxes are right now, you're probably virtually paying close to nothing in taxes. So your total expenses are a lot lower. You also are getting less income, but your total expenses are lower as well because of taxes not being as big of a factor. You know, and when we look at this and go through this with you, John and Jane, we take a look and say, hey, well, if your taxes are low at that point, and based on the current tax situation at that time, maybe it makes sense to look at some things like Roth conversions or utilizing some of that IRA money to move it into after-tax accounts. And we wouldn't go into that with you guys right now, but some of these questions and answers are some of the things that we can look at when analyzing these numbers. All good? Great. So then we'll go back to cash flow. Again, that was the expense column. These planned savings column, that's what's going into your 401k and 403b currently. Now, although it's not necessarily looked as an expense or what's going out because it is going into your portfolio here, from a cash flow perspective, those planned savings are coming out of your paycheck, which means it is coming out of your cash flow. So for the time being, it is looked at as an expense going out. So these numbers are built in right from those formulas we talked about earlier of Jane saving the 5 and John saving the 10%. That's where this is coming from. So if you look at those expenses and what's going out, you add that up, you get the total outflows. Total inflows, total outflows gives you net cash flow. And that's basically, if it's a positive number like it is here, your positive cash flow. If it's a neutral number, it'd be 0 or a couple hundred or so, or maybe a couple hundred negative would be pretty much neutral. And then negative cash flow would be if it was negative a couple thousand, etc. So John and Jane, right now, I know we mentioned in the first meeting that you were thinking you were kind of slightly positive, but based on our conversation, it seems like you might be a little bit more positive than you think you are. Now that we've gone through this conversation, does that kind of make sense? And we'd sit here with John and Jane here and focus a little bit on that just to see if that is the right assumption to build in. Based on our conversations, John and Jane, I think that's, we're pretty much dead on what we're thinking here. So if that's the case, that might make sense for a little bit of the positive cash flow you've been seeing over the couple of years. But that's where the cash flow comes in. This last column right here, total portfolio assets, obviously that is all your investable assets. So that doesn't include the house. It includes your money that is invested in the 401k, the 403b, that trust account, and then the other investment accounts that would be built in here. So this is strictly just the assets that are invested. So John and Jane, I mean, for your situation, you can see if we look at net cash flow, if we're talking about cash flow and focusing, these years right here are your crucial years because obviously your income has dropped off because you're now retired. Anything that's coming is just Social Security. And to support your lifestyle that you're used to living with that $85,000 inflated and the liability payments, you're going to have to withdraw these numbers from your portfolio to supplement that lifestyle. And the reason why this is so crucial and why we're talking about this right now with the current, coronavirus, the economic state, the volatility, is because this is the whole reason financial planning is so important, is about planning for these types of moments and these distributions. You've gone your whole life, John and Jane, of just saving, watching that money, watching those assets grow. And flipping the switch when you retire, although retirement is an exciting time, it's also a huge mentality change. You were going from saving, and now you're withdrawing $97,000, almost $100,000 out of your investments to support your lifestyle. That's a big change. And although it might seem like it's just something you have to do because you got to do it, you want to live your life and you need to pull from your money, the mentality, if you don't have a financial plan in place, that mindset of pulling $100,000 out can be pretty scary no matter how much money you have at the end of the day. So ultimately, again, focusing on cash flow, these are the crucial years. And how do you make that happen? How do you make those distributions happen the right way, the most tax efficient way? Minimizing losses from investments if we're in a situation like we are right now with the coronavirus. If you were here right now and we were having this conversation, you had to take $100,000 distribution from your investments in the current market state, where would you pull it from? Do you know where you would pull it from, John and Jane? Do you know if that position would be heavily at a loss and you'd be pulling out at a loss, a double whammy ultimately? These are the types of conversations that we have to have and we have to focus on because it shows why planning is so important. So again, going after all those line items, John and Jane, going through all this is basically the scenario of your base fact situation. This is the projections, your assumptions. And the reason I say that is because at the end of the day, that's all it is. It's assumptions, it's projections, it's taking some information, building it out and saying, hey, if this were to happen, this is the scenario. But what we see is this is where a lot of advisors stop. They say, hey, you know what, John and Jane, this is what's going to happen. Just keep on doing what you're doing, and this is going to happen. This makes sense. If anything drastic changes, we'll revisit it. But right now, here we go. This is what's going to happen. And that's all great, John and Jane, but how does it actually happen? At the end of the day, these are just numbers. These are just projections. So how do we make this happen? So again, when we're talking with people like you, John and Jane, we realize that if people say, hey, oh yeah, we're doing financial planning. Yep, we're working with the advisor. We're doing planning. This is where they stop. And ultimately, if we were in a situation like this where we had to take these distributions, we might have ran some projections in some scenarios, but is there an actual plan on where these distributions are coming from and how it gets executed? It's an important question to ask. So what I'm going to go into next with you, John and Jane, is how we make this all happen. And how we do that is through what we call our RIS, or our Retirement Income Spreadsheet. So how do we make it happen? This RIS, think of it as the actual strategy, the actual execution of the plan that's working behind the scenes to make all those projections and assumptions potentially happen. Because again, at the end of the day, like we just said, all those numbers that we just looked at are just projections and assumptions. So how do you get there? How do you get to that point? So this RIS, think of it kind of like the strategy working in the background to making it all happen. So what this does is a bucket approach. So you can see there's bucket 1, bucket 2, bucket 3, 4, 5, and so on. So how the investments are allocated and structured are they're structured in different buckets based with different investment allocations based on different time horizons. We're going to go into that in a sec, John and Jane. So let's fast forward. You guys are 65 years old now. Here we have the income need, kind of like what we just talked about with the cash flow a little bit ago. And all that's coming in is Social Security. So from the income coming in, you got Social Security, but this is kind of what you need based on our conversation on what you'd like to live with your lifestyle. This is the income need that you're going to need in retirement. So where's that going to come from? Obviously, kind of like what we spoke about before. If Social Security is only coming in and this is the lifestyle you need, well, you're going to have to pull money out of your investments to supplement that lifestyle. So where are those distributions coming from? And that's exactly what this RAS is going to show. So what we typically like to have is 3 to 5 years worth of someone's income need in retirement structured in a conservative bucket, with the main goal from our team is to not have to sell out at a loss, sell out distributions, give you distributions for your income at a loss. What we like to do is recreate that paycheck for you, like if you were working back when you were working. Now you're in retirement, we're going to send you kind of like a monthly paycheck to your bank account to supplement losing that paycheck. So our main goal, again, in this account is to not have to sell those distributions at a loss. You look at a situation like right now, what's happening with the market, COVID-19, and how it's affected. If there was a bucket, if there was a plan in your portfolio that was conservatively allocated, that might not be getting as hit as hard as some of the others, and you were still getting your income from that distribution bucket, well, maybe you'd feel a little bit more comfortable on what's going on. Maybe you'd feel a little bit more financially confident. So again, this bucket is a little more conservative than the other buckets. And again, our main goal is to not have to sell distributions to you, send you that paycheck at a loss. Now, where do we get that 3 to 5 year number? Well, you go back to 2008, you go back to some of the other, financial crisis, and it's important to mention those, kind of similar to what's going on right now. During those times, if you were able, if you had the liquidity, if you had the position to be able to stay in, eventually your investments did recover. Now, some, recovered longer than others, some were a little more volatile, etc. You can never guarantee those things. However, we know that if we have the time horizon to recover from some sort of market downturn like's going on right now, that's all we can control is time. We can't control the market. We can't control the investments. We can't control specifically what the investments are going to do. At the end of the day, all we can control is time. So that's why we position this bucket with a 3 to 5 years worth of income need to hopefully allow it to recover and then flow in the other buckets back in, which we're going to get to in a second. So as you can see, as you go on to the buckets, we take a little bit more equity exposure in the later buckets. Now, everyone's situation is different. Again, this is just a sample or an example of a situation based on this client profile. But you can see that we take more equity exposure as we go to the later buckets. And the reason that is, as you can see, these, like we talked about earlier, this green part of the bucket, that's where those are the distributions that are going to you. So those are actually taking distributions out of the account. As you can see, in the bucket 1, that happens relatively soon, next year for you, John and Jane. But in bucket 2, basically we have that 3 to 5 years worth of time horizon that this bucket 1 is covering to allow this bucket to potentially grow a little bit more, take a little bit more equity exposure and get hopefully a little bit more growth in this bucket, because we're not taking a distribution out of this bucket, until 2025. Same thing for the third bucket. We're not taking any distribution out of this bucket based on this plan until, 2023, 2020, 2032, or 2033. So as you can see, we have the time to be able to take a little bit more equity exposure, because if we are dealing with volatile markets, we are dealing with ups and downs, we have the time to hopefully be able to ride that out and achieve some more growth in these buckets that are allocated for that. So what all these assets are coming from, John and Jane, you had the 401k through your company, John. You had the 403b through your company, Jane. You had the trust account, and then you also have the pension lump sum, John, through your company. So based on all those assets, we structure all of it out into separate buckets to align for your specific situation, hopefully achieving and executing on that strategy that makes those assumptions in the previous plan come true. Now, as you can see, you can notice that, John, this is your IRA, John, this is your IRA, the lump sum kind of lumped in together. We spread those out over 3 buckets. Jane, this is your 403b, now in an IRA, spread under this later bucket. You can notice that we have the trust account aligned for the latest bucket with the longest time horizon until needing to take any of the money out. And the reason we typically like to do that is based on everyone's situation. Obviously, everyone is different. But a lot of the time, if there's a client that wants to leave a legacy, wants to leave something down to a beneficiary, a charity, whatever it is, that we like to leave the after-tax, like Roth IRAs or trust accounts, we like to leave those accounts and push them out to later and leave those as the legacy piece. Because at the end of the day, if those go down to beneficiaries, hopefully it's a lot more tax advantaged to the beneficiary than leaving an IRA or something that's pre-tax or a qualified account. And that's even more so now because of the Secure Act and the recent changes that have changed there, moving the RMDs, like we talked about earlier, to 72. It also eliminated the lifetime stretch rule. So now a non-spousal beneficiary has to liquidate or has to take all the money, the assets out of an IRA by the 10th year versus being able to stretch it out over their lifetime. So from a tax perspective, leaving those accounts kind of later on down the road could make more sense in someone's situation. But again, everyone is different. But that's why we leave typically trust and after-tax monies like a Roth IRA down here for legacy, if it's suitable for the client. So when you look at all of this again, you say, okay, Andrew, that's great. We have this bucket here, 3 to 5 years worth of our income need. Yep, I get all that. That's where the distributions are coming from. Hopefully that's a conservative bucket of money that hopefully we're getting that paycheck. We don't have to sell it at a loss too many times. Completely understand that. But what happens when this 3 to 5 years is done? What do we do then? Well, that's the whole thing about why this RIS is so important, is just like the plan we went through before, John and Jane, this is not static. This is something that's always changing. So the analogy I like to use is, think of a staircase that's water flowing down through it. The water doesn't just stop as it goes down to the next staircase. It keeps flowing down and down and down all the way down the stairs until the bottom. And that's kind of how this RIS works, is this 3 to 5 year, this bucket one, this conservatively allocated bucket is never going to go away. It's always flowing back through from the later buckets. So even though this one is stopping in 2025, because that's the 3 to 5 years worth of the need, then there's going to be another 3 to 5 years worth of your income need and another 3 to 5 years worth of income need. So as you can see down here, March of 2020, there's going to be, a July of 2020, a December of 2020, a July of 2021, and so on and so forth. So when we're in review meetings, we're focusing on this RIS, and there's always going to be tabs showing the history and the present time of what's going on with your RIS. And the monies from these accounts over here are always going to be flowing back through, building back up a bucket one, building back up a bucket two, building back up a bucket three, and so on. And we're always analyzing this. We're always looking at this. A lot of financial advisors, a lot of people spend a lot of the review meetings talking about investment performance and what's going on with the market, and the coronavirus affected these the most, and these are good stocks to buy, and blah, blah, blah. And all that is great. And you need to talk about investment performance. It's very important. But at the end of the day, this is the strategy that's going to make the financial plan happen. So we like to spend a lot of our time in review meetings talking about the RIS, talking about the plan, and focusing on that to make sure that it's still aligned appropriately for your situation. For an example, we were in a market that had a lot of growth for a lot of years, 9, 10, almost 11 years worth of good growth in the economy and in the stock market. And we looked at that situation when we're looking at all their clients in the RIS. We say, hey, we've had a good run, we've had good performance, we were able to take advantage of good growth opportunities because we had a good economy and good market. So these later buckets that were more exposed to equities, they had good growth in those accounts. So we said, hey, let's not get greedy. Let's maybe take a look at this and maybe let's pull a little bit off the table now that we've been in the 9th, 10th, 11th year of a good market. Maybe let's build up this 3 to 5 year bucket, this, the conservative bucket a little bit more, because again, why get greedy when we've had such, good returns here? Let's take a look about building that up. And it works vice versa too. Now we're in a situation where it maybe takes a look in the example and say, hey, there might be some opportunities to maybe put more money in the equity exposed buckets. So, if we think that the market maybe have an opportunity to grow more, maybe we take some off the table from the first bucket and move it out to the later bucket. So it goes both ways. But the point of the matter is that we're always looking at the RIS, we're always looking at the plan and making sure that it's working appropriately for your situation. And everyone's situation is different. And that's why having an RIS, having a financial plan is so important, especially in times like what we're seeing right now with the coronavirus and how it's affecting the economy. So this is how the RIS works, and that's how we make it happen. So if we go to the next part, this is the consolidation spreadsheet for you, John and Jane. So we just went through the RIS, we showed you how we would structure out those buckets, but how do we get to that point? So as you can see, John, you had your 401k, you have your pension lump sum, those are going to be IRAs. Here's how we would take those amounts of monies and move them into those buckets. So you can see, John, your company 401k that had the 600,000, we're going to split those up into bucket 1 and into bucket 2. John, your pension lump sum, we're going to take that amount and put that in bucket 3. Jane, your IRA, that was a 403B, that's now an IRA, 400,000. That's going to go into bucket 4. And then finally, the trust account, moving into bucket 5. Each bucket has their own strategy, which again, these strategies will be different for each client. This is a hypothetical situation showing for John and Jane, a hypothetical situation, but we would show the strategies that we would utilize in each of those buckets. So that's where the money's coming from for each bucket. We go through that and show John and Jane, this is where we are getting these numbers and this is how we're going to get them to where we go. So what this does is, and then if we go back to the RIS, you can see that these are the buckets that we just showed and consolidated to. So again, in closing for this RIS, this is how we make it happen. This is why it's so important to have a distribution plan with your financial plan, because at the end of the day, if you stop at that first part that we went through, how do you make that happen? You might be running good projections, you might be inputting all that data and all that information correctly, and you say, oh, that looks great. But again, it's how do you make those projections, assumptions potentially come true? And this is how we make it happen. So John and Jane, going back to the cash flow report here, you can see that, again, if we can make it happen based on those assumptions and projections that we're having, this is what's going to happen based on those assumptions. So is this something that you actually want to have happen? And this would be the point of the conversation where we would we would take a step back, John and Jane, we would talk about what we just all went through. Does it all make sense? And kind of, again, circle back with all those bits of information that we just kind of threw at you. But John and Jane, one thing that we didn't mention here is, again, that this is so non-static. Projection assumptions are meant to change. One thing in here, John and Jane, that we didn't mention is looking at these total expenses. When most of the time when we see people in retirement, we see that, they're spending their money in the early years of retirement. They're spending more money, doing trips, doing vacations, having fun with grandkids or family, etc. Spending a little bit more money while they're still lively, healthy, etc. So maybe this expense is a little bit higher, but then it kind of works like a bell curve. You spend all that money, you do your vacations, you have your fun, and then as you get later on down the road, the expenses start to slow down. You spend a little bit of money, maybe you're spending more time at home, not going on lavish vacations or doing more fun things, and it's just kind of just staying at home and having fun there. So we kind of see that as a bell curve. But right now in this assumption, we're just showing the expenses continue to grow based on this inflation. So that's a number that could affect the plan pretty substantially if you were spending a lot less money. Ultimately, that's just going to be a lot more left over in this buckets over here. Again, these are the types of things that we ask the questions, John and Jane. These are just assumptions, but based on these assumptions, this is what's going to happen. So if this isn't what you want to have happen, there should be a strategy we should continue to review so we can put a strategy in place to make some of these things happen. One of the other things, John and Jane, that we didn't mention is you can see all this positive cash flow that we mentioned earlier. Basically, starting when you take your RMDs at 72, you have all this positive cash flow. Well, in this plan right now, we're just showing this positive cash flow just go right into the bank. And you know what it's earning at the bank. Not as much, obviously, hopefully, as it would be if you were having it invested. So obviously, if we had all this positive cash flow or some of it flowing back in the investments and earning that 5% rate of return assumption, then this bucket of money would grow even farther. So again, if you take some of these assumptions we have in are going to change for better or for worse based on these numbers. And that is why it's so important to have a plan, to do financial planning, to have a strategy so that you can plan for some of these things. And, John and Jane, we can show all those different types of scenarios. For this situation, for this plan, this is just the base facts. This is just what we talked about in the first meeting. This is just what we've talked about since then and from that information that we gathered. This is just the base fact scenario. But we can run all different types of scenarios to show different things. Purchasing a cottage, paying for grandkids, education, anything you can think of, we can build those things in and show you the impact. And what that empowers you to do is make a confident decision, because you can say, hey, we saw how that's going to impact the plan. Andrew, we don't really feel comfortable doing that right now. Maybe we hold off. Or you look at it and you say, you know what, we can do that. We feel comfortable. Let's make it happen. And you make the decision. So what this does is it instills confidence in your situation, which ultimately, again, can make you more financially confident, more financially comfortable. So at this point, John and Jane, we've gone through everything. We've gone through your questions, your concerns. We've addressed them all. At this point, we would then continue to talk next steps, see how they were feeling, and continue on that way. So this kind of concludes the presentation on the financial plan, how we manage the money, how we structure the buckets out to execute the goals and make these projections and assumptions potentially happen. That is kind of an all-encompassing rough draft of a presentation that we would go through. Again, everyone's situation is different. Everyone has different concerns, different goals. So everything is structured out differently. So I would not focus specifically on this situation as how we would present to everybody. That is not the case. Everyone's situation is different, and we have to account for that. Because at the end of the day, it is our responsibility to do that for clients. So again, that would conclude this part of the presentation. That would conclude the meeting. We would continue to discuss, have a dialogue about what we presented, and discuss next steps. In conclusion to this webinar, I would first like to thank everybody who has watched through this presentation. I hope you gained knowledge, you gained some value and some insight on why financial planning is so important, why it's so crucial, especially in times like what we're seeing right now. Having a plan, having a strategy working in the background makes you a lot more financially confident. It makes you more comfortable. And what it really does is it puts a purpose behind your money, behind your assets, behind your portfolio, so that it's doing something, it's executing on something, a strategy for you at the end of the day. And especially right now and in other times where there's downturns or other times in your life where there's situations where things happen that weren't necessarily planned to happen, it puts that constant out there that at least you know that there's a strategy and you know something is working for you in the background. It's very important. So again, thank you very much for going through this presentation. We really appreciate it. What I'd like to do in closing is, if you watch this presentation and you feel like that your financial plan is not necessarily meeting your needs, or you don't have a financial plan to begin with and you would like to explore that option, we would love to have the opportunity to sit with you and review your specific situation. Again, this situation was just a hypothetical example. Don't focus too much on the numbers, or if your situation is vastly different than what this example client was going through, we would love the opportunity to sit down and review and hopefully go through this situation with you, this process, and provide value for you and your family as well. If that is something that you would like to explore, feel free to reach out to our office at 248-265-6662, or you can email at info@horizonadviser.com. Or lastly, you can go below this video. You'll see on our website, you'll see a Start Here button where you can look through our process. You also see a contact form to fill out and send to us, and we can reach out to you that way. So again, thank you very much. We would love the opportunity to review your specific situation and help your family. But at the very least, we hope that this served as an educational piece so you gain more knowledge and gain more insight on how financial planning works and how it could potentially help your situation. Thank you very much. God bless, and I hope you and your family stay healthy and safe during these times. Thanks again.